We are going to start. Welcome everyone. Today there we have people online. We have people here on site at the Faculty of Law, Leiden Law School. And for some of you, this is kind of like the follow-up of the side-by-side agreement, but we do have here today 4 speakers discussing about international tax after Trump, where we will discuss about the Pillar 2, but at the same time, we will also discuss other consequences of international taxation regarding Trump. So I'm very happy to invite everyone to have the people here. We do have online Peter Hongler, Professor, University of St. Gallen, Surajali Tandon, Associate Professor in the National Institute of Public Finance in India. And then we have here at the Leiden Law School, Alison Christians, Professor, McGill University, and Tarcisio Diniz Macalcajes, Associate Professor at the University of Antwerp. So with this, we will start. It will be recorded, but as you know, we have this privacy and data regulation, so you have already agreed to that. And we will start together first with Peter Hongler, then after Suranjali. We have some time for questions. Then after we will go with Alison and Tarcisio. So thank you everyone for being here, and it's my pleasure to welcome everyone. Peter, you can unmute yourself, and I mute here.
Fantastic. Thank you, Irma. Thank you, everyone, for joining. I'll try to give you a bit of a big picture of the world in which we are and the world in which Pillar 2 operates right now. So I'll talk about 3 things. First, some macroeconomic trends, then some legal trends, and a bit look into the crystal ball of what will happen in the next couple of years, depending on whether another Republican government will stay in office or not. So what are the macroeconomic trends? And I think it's sometimes again important to look back. And one number that is always key if we think about tax policy is the tax to GDP ratio. So the ratio between the amount of taxes we levy and the GDP in countries. And here you see the OECD average, you see a few European countries, you see a few other countries on the slide as well. There is no clear trend. However, I do have a certain feeling that once you reach 45%, 50% tax to GDP ratio, it's very difficult, to tax the society more than that. There is no scientific evidence for that. But somehow, we have a plafond at around 45% up to 50%, depending a bit on how we calculate the tax to GDP ratio. So what does that mean for us in Europe? In many jurisdictions, we have reached probably the limit. So we are only talking about, what kind of taxes we can levy, where can we reduce other taxes. It's about rebalancing the burden. Second very important point, if we think about the spending side, I think we always need to understand right now the main reason why we are in a fiscal crisis in most jurisdictions is demography. So demography is, it's automatic that there will be a lot more spending down the road, and we won't get rid of the problem in the next couple of years. So spending will be there for sure. It's going to be very difficult to make significant cuts in the coming years. Moreover, due to the demographic developments, there will be pressure on growth. So just as an example, Germany starts with a negative growth every year due to labor supply that moves into retirement. That's, I think, a key topic to understand. So therefore, first conclusion, deficits will increase in many jurisdictions, which again means we will also very likely see higher interest rates. And that's also, there is a common understanding about that, and it's very difficult to change that. We might have some test countries where, capital markets try to figure out where the limit is, whether you can push some countries over the edge here. And, the UK is an example, or Japan is an example. But fiscal pressure will just increase in the next couple of years. And again, it's very difficult to get out of that. That's an important macroeconomic trend. Now, of course, the topic that we want to discuss today is, what does corporate tax, why is corporate tax relevant here? And I think, the BEPS project, but also BEPS 2.0 started with the idea of taxing corporates at a higher level. So again, rebalancing, we want more money from the corporates, whatever that means, where the incident is, but we want more money from the corporations. Now, what's the problem there? If we look at the market capitalization of the largest 200 companies, it is obvious that, it's mainly US companies. So if we look at the value of listed companies in the US, they among the 200 top companies amount to around 70% of market capitalization. So if we really want to tax corporates more at the global level or in a coordinated manner, then we need to talk about taxing US corporations. Or to, phrase it a bit in a more provocative manner, the current minimum tax is a tax for a minority. And I think that's a key to understand. Now, next point, of course, I do, focus a bit on the European perspective here. And I often use this slide here because it's on one hand very depressing. On the other hand, I think it makes visible a key issue. In Europe, we have a huge competitive disadvantage for whatever reason. So what you have here on this slide, which went viral, is the companies that were created within the last 50 years that have a market capitalization of more than 10 billion US dollars. So you see on the right side, the EU, it is very depressing. So the European Union was not successful in creating a lot of large multinationals, a lot of generational companies over the last 50 years. The US, on the other side, they have pushed in that regard a lot, and we have a lot of new US companies that have a valuation of more than 10 billion US dollars. So there is, of course, a competitive disadvantage in the European Union, and I'll talk about that in a minute, what that means from a tax perspective. Now, let's dig a bit deeper into the tax question here, because, and that's my reading of the One Big Beautiful Bill Act, it basically means that US is pushing tax competition to the next level. So there are many provisions in the One Big Beautiful Bill Act that have led to significant lower corporate tax rates of US multinationals, and I focus on cash tax rates. So just a few examples: immediate depreciations on some investments, immediate expensing of some R&D activities, but also, more liberal tax credits, a more liberal approach to the FDDI, so the foreign intangible income regime. So all of these measures have led to very low corporate income taxes in the US. And here is just an example by ITEP, and they have done that for all companies. But if you look at the 4 examples here on the slide, of course, Tesla is a striking example. Tesla did not pay a single US dollar in the US at the federal level of US income tax, corporate income tax during 2025. So this is the world we are. We have one part of the world that is bound in the side-by-side arrangement, and the other side that is pushing, through new competitive measures. Here, you see the result. So in other words, if you have a side-by-side regime, it can be very harmful if you are on the wrong side. And I think that's the problem right now. The EU is on the wrong side, the US is pushing, and therefore we will see even more competitive pressure in Europe over the next couple of years. Next point, here is some evidence on that. I have not done a comprehensive analysis, but if someone wants to do that, I think it would be a very interesting topic. US multinationals, in their 10Ks, they have to disclose how much income is domestic income, so that means accounted for in the US, and how much income is foreign income. And here, at least, if you look at NVIDIA and a few other companies, but again, I have not done a comprehensive analysis, you see a trend. And the trend is that US multinationals tend to have more domestic income compared to foreign income. Why is that? Because it is more beneficial nowadays to sell invoices out of the US directly into the world, to penetrate markets directly out of the US. You don't need presence anymore in Europe, or at least presence with high margin business in Europe. I think that's a conclusion that you can derive from such data. Here is just an anecdotal evidence, that is my invoice I received from Anthropic for my cloud license. You see, you get the invoice from Anthropic Pasadena, California, and not anymore from an Irish company, as it used to be the case, when the digital world started a couple of decades ago. So I think we need to understand that we have these mega trends. So the more digital, the more automated services become, the more we see cross-border business. And because of, tax competition, the more we see that US multinationals will do that out of the US. Okay. So these are the macroeconomic mega trends that I see are important to understand. Now, what are the legal trends? First, and here, I know I have some other speakers on the panel that might disagree with me, but my reading of Pillar 2 is that it is a risk to end, the value of tax treaties. Why is that? Because until the UTPR and the IAR were implemented, we had quite a strong legal framework in the sense tax treaties tell us who can tax what. Now, with all advantages and disadvantages, and I think we are all aware that tax treaties also come with disadvantages. But what will happen now, depending on how courts will assess the interaction between the UTPR, the IAR, and tax treaties, it could be that the value of tax treaties is not that high anymore, because basically we have moved already into an age of realpolitik. So the stronger economies basically decide what they want to do. And the feature that they use nowadays is the Q status. And I think that's the interesting part of it, right? The Q status basically is the feature of realpolitik nowadays. Why is that? Well, who decides about whether you have a QD entity, whether you have a qualified IAR, whether you have a qualified side-by-side regime? It is the inclusive framework, and we do not really know how they decide on that. So in the old days, we had tax treaties. Nowadays, someone tells you you are qualified or not. I think that's a major move from a multilateral system into a more realpolitik-based system. Next legal trend that I see also triggered by Pillar 2 is that we refer to, a variety of foreign standards to assess what the tax burden is in a certain jurisdiction. And personally, I believe that is an underestimated design failure of Pillar 2. Why? Because, of course, it challenges our traditional understanding of the rule of law. So taxation, at the end, it should be a decision by our parliament. What is the tax burden? Who should pay the tax, etc. But with Pillar 2 and the reference to an unknown amount of accounting standards, basically we have given that decisions to other bodies. It can be private bodies like the IFRS foundations. It can be also other governmental bodies in other jurisdictions. And I think that's important. So that's a major design failure. And I think a major reason why probably Pillar 2 will fall apart down the road. The corporate alternative minimum tax in the US works differently. Right there, we have one standard. We could have done that also with respect to Pillar 2. But somehow there was no, international agreement about that. But we could have agreed on IFRS. We could have agreed on US GAAP. But we have agreed on an unknown amount of standards. And I think that challenges our traditional understanding of the rule of law. Third trend, of course, it's the institutional question. It is still unresolved. And Alison has written a very interesting paper about the non-inclusiveness of the inclusive framework. I mean, the latest publication, the Global Minimum Tax Implementation Toolkit, was even financed by the European Union. So I'm completely lost now from an institutional perspective. Who does what at the inclusive framework based on what reasons and who pays for that? And so the institutional question is unsolved, still unsolved. So what is next? Let's talk about the macroeconomic perspective first. First of all, I think raising more taxes will be very, very difficult. Again, we talk about rebalancing. Maybe some countries will raise their inheritance tax. Maybe some countries will increase or will implement a wealth tax. But in general, to raise more tax relative to GDP will be very difficult in most European countries. Of course, the exception is the US. There we could still implement the VAT and by doing so, get significant more money out of the society for the government. I'm not saying whether they should do it or not, but there is room for maneuver in the US, not so in the US, and not so in Europe. Now, here, Pillar 2, I think, is more harmful than helpful to raise more taxes. Why? Because it has a negative impact on growth. And I think it's key to understand that the fewer countries implement Pillar 2, the more harmful it will be for implementing jurisdictions. And I think especially EU representatives should consider that going into the negotiations, whether the Brazilian system qualifies, the Indian system qualifies, the Chinese system qualifies for any of the safe harbors, because the less countries you have in the system, the more detrimental is it for those who are still in the system, because it becomes more expensive to invest into these jurisdictions. And I think that's a very, very dangerous path we are on right now. Third, I think it will also be challenging to decrease spending significantly, at least in Europe, due to political pressure. I'm not saying we should not do it. I'm just saying it's going to be very difficult to decrease spending significantly. So we have, first, difficulties to raise more taxes. Second, we have difficulties to decrease spending. That means, deficits will be there for the next couple of years. And of course, the consequences are or is inflation. For sure, we will see another inflationary trend. It has again started in Germany, for instance, and in other jurisdictions. And again, final conclusion here, Pillar 2 is more harmful than helpful in that respect. Second, on the competitive question, I think we should not overestimate Pillar 2. Pillar 2 constitutes a minor contributing factor to the decline in competitiveness of the European Union. I think there we should be honest, but it is also a minor problem to fix. So if you want to solve, that the European Union is not competitive anymore, you have to take a variety of measures. But if you fail to get rid of Pillar 2, I think it's a strong sign that you might also fail to do the reforms that are really costly and that are, also detrimental for society. And I think that shows us, why it's going to be difficult. So it has a minor contributing factor, minor problem to fix, but as far as it seems now, we are even unable to fix that problem in Europe. And I include my country, Switzerland, here as well, because we do follow the European Union in that respect to a large extent. So what about the digitalization automation mega trend? What will we see there in the next couple of years in a post-Trump environment? First, pressure on source taxation will increase, and that's 100% sure. So we will see a new Pillar 1 project, one or the other, at the UN or at the OECD. But the more digital the world will become, the more we need finally to solve the source problem, the nexus problem. And I'm still a supporter of a Pillar 1 solution, have been since the beginning, but we should be honest, Pillar 2 does not help us in that respect. So Pillar 2 does not help us with, the fact that more services are digitalized, are automated, and more of the services are rendered out of the US and not anymore out of Europe. So to solve that problem, Pillar 2 again is the wrong solution. Now, let me focus on the legal trend here. So, and I'm a lawyer, and I think we live in a very interesting time because now courts will have to assess all of the questions that we have discussed. And I know that Tarcisio is going to talk about the ECJ case, and so I'm very short in that respect. But it's fascinating, right? We have so many unsolved questions that need to be discussed by courts, both in the European Union or at the EU level, in the domestic courts and in other jurisdictions. First, what is the role of tax treaties? What is the relation between tax treaties and the UTPR and the IAR? What is the role of the rule of law? So will we see courts that would say, well, I'm fine with outsourcing some of the legislative activities to foreign legislator? Let's see. And of course, another question that I don't have the time to discuss is there a limit to tax jurisdiction, or is the UTPR excessive? Now, all very complicated questions. All questions are quite new. So let's look for some court decisions in the next couple of years. On the institutional side, it's up to the delegates to solve the institutional questions. I see three options. One is to collapse, as Alison will talk about later, so that basically we will have even less cooperation in the future. Second option would be that we at the UN agree on a principle-based framework convention. And that's the way I would suggest we should go. What does that mean, a principle-based framework convention? We should agree on the institutional part only now, otherwise we miss a chance for a generation. Because if we agree or try to agree on a substantive-based framework convention, so for instance on a reallocation of taxing rights, the whole project will fail 100% sure, because it has failed for the past 100 years. We have not found an agreement on how to allocate taxing rights at the global level. We have not agreed on a multilateral substantive tax treaty at the global level. So we won't, find an agreement in that respect. This is why I do have a strong favor for a principle-based framework. Looking at the time, I conclude here. In its current form, Pillar 2 is the wrong project at the wrong time in the wrong jurisdictions. Thank you.
Thank you so much. I think that, Peter, your conclusion, it gives us food for thought. And I know that one person just entered exactly at the moment that you were saying it's the wrong project at the wrong time and in the wrong jurisdiction. So we have this recorded, so it will be available for everyone. Thank you so much, Peter. Let me now go to Alison Christian. She will be here from the Faculty of Law. And for the ones who are here, there is coffee and some drinks on the back. For the ones at home, you will have to do it yourself, and my apologies. But anyway, please, Alison, we will go, and then after we will have some Q&A. And please feel free to just share your questions either in the chat or just raise your hand after the presentation of Alison, where we will have some time for questions.
Okay, so thank you. So I'll just make sure I'm in view. Hi. Hello, world. Hello, everyone in the classroom. It's delightful to be enlightened. So thank you, Irma, for putting this together. It's just always a pleasure and always a privilege to come and be in your orbit, be around all the people that you bring to these productive, collaborative conversations. So thank you. And I enjoyed, Peter, I enjoyed your presentation very much. You bring you brought that last sentence in, and I don't know if everybody realized it was a little bit of a play on that we should tax the right income at the right place at the right time, and Peter just flipped that right on its head. So that's well done. Okay, so my paper, my topic is untitled a little bit right now, but it's something like what happens next, international tax after Trump. But at one point, when I started giving a talk about this paper, I started using kind of metaphors to explain the approach that I was giving. And then people said, oh, that has to be in the title. So I started saying, okay, is this in the title? But then the title is getting too long. But the title would be something like Collapse, Boomerang, or Hail Mary. What's next after Trump? It's too long, but as soon as I tell you that you've got those three, you know where I'm going here. So Peter already anticipated me giving me collapse. What I'm saying is, well, what's going to happen next? And the first part of the paper, setting the stage, a century of tax coordination, and Peter already kind of gave us some of that, so I'm going to be able to skip that, except to say that we've had a century-long push, right? Efforts from the early 1920s to address double taxation, still ongoing. It's a century-long trajectory of like problem solving, and I am being purposefully using passive construction and not saying who's doing the problem solving, because in my scholarship I often bring up, well, who's saying what the problem is. And I think Peter covered that also. He's talking about like who the decision makers are. And this has always been the issue. This has always been the issue and it's still the issue today, and it will be the issue tomorrow. But we know that we end up where we are now with our model treaty and our multilateral or our bilateral treaties and our few multilateral coordination. We end up here because of a basic disagreement, right? Source versus residence. Who should have privacy? This is the basic disagreement. We started there 100 and some years ago, and we're still there fighting about this. And we also started with that basic logic. Cooperation versus competition. Nothing has changed. The basic framework has not changed. And we're still discussing each country's thinking about, well, is it better for me to cooperate or is it better for me to compete? And nobody can say that that hasn't been a fun ride to watch, right? Like this has been a fun roller coaster. Sometimes you're up and you think competition's great. Sometimes you're down and then you think cooperation's great. And I will say I haven't done as an entire study of the century, but it seems like we are seeing the roller coaster of this is when the market crashes, we cooperate. When the market is thriving, we compete. So when there was the financial crisis, that is when we get our current structure for cooperation, because a whole lot of countries were like, it's not actually great for us to not be able to fund the welfare state. People get mad at the politicians and they push them out. And so these institutions that are shaping policy are reacting in and out, coming in and out of focus on whether it's better to cooperate or compete. And you don't actually know. But one thing has been true, one mainstay all the way through for 100 years, and it is that the US has dominated the policy while not following it. Dominated the structure of rulemaking while not accepting the rules that get made. Shaping, molding, guiding, pushing their influence, but not adopting the rules. And that's not just tax. The US has done that in every way, from the Vienna Convention all the way down. This has always been the way. So there's nothing new here. This is not new. This is a very consistent behavior. And so this dominance of the US and its volatility is where sometimes there's a regime in power that seems to want to work towards cooperation, and mostly there's a regime in power that does not, or in fundamental ways does not. Okay, but that's constant. That's not new. So when we talk about international tax after Trump, we're saying something has happened that is new or is more extreme than the past, but the trajectory has always been there. Okay, so that's, we can spend a lot of time going through the history, and we're not going to do that. We're going to talk about now that Trump has come along and done something that looks more extreme, but is not actually new. It does reflect a long history of US behavior, what comes next. So I gave you collapse, boomerang, and Hail Mary. What do I mean? Okay, so this is obviously the meat of the paper. And whenever we write a paper, we always have this background. We have to do the background section. We have to go through the history. I write it every time. I've written it 100 times. I don't think it's different next time than it would be the time before that. But here's the real reason to write this paper. It's not that I know. I don't have a crystal ball, and I don't know what's going to happen yet. But I'm at a stage in my writing where I say, well, what is the point of writing about the transfer pricing guideline change? Or what is the point of writing about, whatever is in the UN Framework Convention, if in one day Trump flipped the entire thing upside down, shook everything out, and said, now just accept the new us, the new world. What is the point of studying the future? So I'm in a dark place in scholarship terms, right? Like, what is the point of this writing that I'm doing? This is not, there's nothing to say, because everything is getting ripped up, shredded. And of course, it's obvious that countries are going to be like, well, if the US is not in, I'm obviously going to be hurt. Clear, we can see where this is going. You don't need a crystal ball to see that if the US is out and they are 70, I think Peter gave us 68.7 or close to 70% of market cap. They're the ones that are not paying tax. They are controlling everything. They are in every market. And if they're out and they can't be taxed, no one can be taxed. So it's a very dark time. The only way out is to say, okay, well, let's look at what is likely to happen next. And then even though we don't know what's going to happen next, at least if we envision it, we can say to ourselves, well, what institutional rules, structures, norms would we prefer to avoid from the past? Let's not keep doing them. And which ones should we introduce? And that's the basic thrust of this paper. That's it. That's what this paper is about. It's just saying, hey, if you think about what's probably going to happen next, and we have some opportunities here. There's some terrible things happening, but we have some opportunities here. This could be the moment to try to get some of these in, but we have to think about it, like be a little bit deliberate about thinking, okay, there's so many things that could happen. I can't even handle thinking about them. But what I can think about is, well, if we do X, I'm not going to be happy with that outcome. So could we figure out that we want a different outcome on the principle? And it does follow, I think, from Peter's intuition that we should be thinking about principles, because since we have this uncertainty and volatility and an unstable trading partner, we have to think, well, what are the principles that we want to apply first, and then think about how we're going to apply them. So what is the first scenario, collapse? Well, here's what I'm thinking. If you kind of follow down the road of the US withdrawing from things, withdrawing from BEPS is step one. What about withdrawing from the OECD altogether? What about yanking funding? What about shutting down the UN? What if the US puts a fence around the UN and locks everybody out and says that's no longer, you can't use that building, we're going to rebrand it, it's now Trump International Hotel 73 on the banks of the river, the UN is done. What if it's a total collapse of all the institutions because the US pulls everything out and stops funding? There's no more funding if the US stops funding the OECD. There's not enough. It will not be able to continue. There's not enough institutional support without the US. So if the US does that, then the whole system would drop. But then you say, okay, but would the treaties, like would Canada still have a treaty with the US? Like, maybe, but what if the US says no more treaties? What if? Okay, so you can go down that route and you can say, okay, we would be going back to 1921, right? Before the League of Nations, before the first model treaty, we'd be back to zero. And it would mean a bunch of protectionism. And what is the likely outcome? Well, war, total war, because everybody will be fighting for resources and there will be there's no stability whatsoever. And it will just be, that's a pretty bad scenario. So in the paper, I kind of go through what that looks like, but this permanent exit is like the entire structure of norms. You have to imagine if you took them all away and you return to unilateralism, what's going to happen? Well, it seems like from the story that we've been telling ourselves is it will be a race to the bottom. There will be extreme tax competition. Every tax base will be eroded beyond recognition. Nothing will work. The end of the use of OECD standards, whatever harmonization gains we had achieved, even if they were minor, even if they were small, like we can't have a conversation anymore because we're going to use different language and we don't understand each other. That's the basic idea of collapse. Is this likely? I don't know. I'm not saying it's likely. I'm just saying when you go back to that world, if you cannot even use the same word, even fight about, like if I say beneficial owner, everybody in this room has an opinion about what beneficial owner means and we can have a conversation about it. But if we don't even use that term because the entire structure is gone, then what are we using? How are we coordinating? It's all internal. And it's just an unraveling, right? It's just a great unraveling of commitments. And you have to assume then you're starting over. Okay, so I'm going to connect collapse to Hail Mary in a minute, okay? But before I get to Hail Mary, we got to talk about this boomerang scenario, which seems, I think if you're optimistic right now, if you're like just a generally sunny personality and you just think things are going to work out, boomerang is probably the scenario you're envisioning. The US is out right now because things are a little extreme, but then there will be midterms or there'll be another election, there will be regime change, and they will come roaring back. They will come back into the OECD, they will come dominating all of the conversations again, and we're just going to pick back up and keep moving forward. Okay, so scenario 2, this boomerang scenario is kind of comforting if you want to be optimistic about the status quo. If you don't like the status quo, you don't like the boomerang. Okay, but if you like the status quo, there's something about the status quo that's like comforting. Like, okay, well, it's okay. We're going to hang on to some of these concepts. We're going to hang on to the idea of harmonization because the US is going to come back. And when they come back, they'll start barking at all the rest of us again about what to do and how to do it. And, you know, how we have to do it their way. But we're used to that. We know how to do that, right? But like, what is this idea? It is that it's just a short-term disruption. Like when Trump exits from Globe, it says, everybody that's doing Globe, I'm going to tariff you, I'm going to tariff you, I'm going to tariff you, all of this stuff, it's all going to stop. And the US is going to come back and be like, okay, now let's go back. What were we, Working Party 6? What were we doing? Let's go back to it. And can you imagine being in that room like, but it's like a bad date that comes back, like a bad relationship that comes, like a bit toxic, right? And oh, you're back. Oh, now we have to do what you say again. And, you know, it's like, but for the sake of stability and because they have so much money and because we're so reliant and we built this world around trade with the US, well, we just have to accept it. But trust is broken. Trust is definitely broken. But the structure is still there. And I think that there are people, lots of people in the world who are invested in this outcome. Like just wait for the boomerang to come back. Like you're out. It's a bit crazy right now, but just wait. We're going to go back to normal, quote unquote normal. And normal, quote unquote normal, is US-led, US does not cooperate world. The one that we had before they withdrew altogether, where the US dominates the discussion, they lead all the committees, they go to all the meetings, they bring all their expertise. People listen to them because they're very skilled, very knowledgeable, very sophisticated, and they control the narrative, and we all do what the US wants because they control the economy as well. This scenario, I submit, is not one that we should be sleepwalking into. We should not be like, in the back of our mind, we're optimistic, sunny people who think things are going to work out. They're going to go back to where they were, and this is what's going to happen. The US will come back and we'll just pick back up again and, you know, start doing our thing again, do our harmonization thing. I don't think that that is actually the optimistic view. I actually think that is the conservative status quo view. But it feels like optimism, like it'll be okay. It's just a little blip. We'll go back. So what I think the actually, you know, maybe radical, you might say radical. No one would ever say that about me, right? Never. But the sort of actually optimistic view, like the real one, the one where you think this is our moment. This is the Hail Mary, okay? So in the paper, I'm describing the Hail Mary moment as, okay, I don't know if you, I'm sorry about this, to do this to you, because this is a US sports metaphor, the Hail Mary. The Hail Mary is when you're down by a point at the end of the football game, you know, US football, where they tackle each other, that one. And you're going to lose the game unless you can throw the ball, you know, all the way to the other side and the guy can catch it and you get a touchdown or something. I don't know, it's just like 1 in a million shot, okay? This is basically 1 in a million shot to get something good. So I actually think this is the other side of collapse, possibly, or it's the opportunity that arises in the anticipation that there could be collapse, okay? So I'm not sure how these categories work together, but it's something like this. And the Hail Mary is this: the US has rejected the international tax system right now. They're pulling out right now. They're not there right now. So everybody else can get together and decide what the rules should be. And they don't have to be the same rules as they used to be. They don't have to be the same institutions as they used to be. They don't have to be working parties staffed the way they used to be. The entire structure could be changed. The terms and conditions to cooperation could be entirely rewritten without the US. And then if they do boomerang, there's nothing for them to boomerang to. They have to accept the new conditions. They have to accept the new terms. Because the people that made the new terms and conditions made them without the US, without catering to the US, without deferring to US expertise, without using the sophisticated approach of the US, and in anticipation of a world in which the US is not involved. Which means, I know, okay, now you could maybe call me radical. Again, this paper is just saying, look, if this happens, what would you say about this opportunity? What would you say? Would you go back and say, well, but the OECD kind of more or less had it right? No, nobody would say that. Nobody, well, yes, some people will say that. Some people will say the OECD had it right, and there will always be people that protect that status quo and try to bring it back in. But if you had this opportunity, would you say, well, it's the UN? Well, not if you think the UN is about to collapse, would you? You wouldn't. You wouldn't say, well, let's just go back into the UN system. But you might say, but those, I think it's 100, I don't even know how many countries are in the UN. Is 170, something like this? I don't know. Let's say.
192.
192? Yeah. Okay, perfect. 192 countries have organized themselves around this institution. They know each other. They might pick up and say, well, okay, the building is closed in New York. You know, what do we do now? Do we move it to, do we like have our meeting somewhere else? Do we set up somewhere else as 192? Or is it maybe 191 because no US? Or is it maybe 190 because no US and no China? Is it maybe 189? No US, no China, no Russia? Do we just, you're right, you can imagine like the major powers being left out of that structure. Now, I thought this was kind of a radical possible, you know, just to think about it. I'm not saying what's going to happen. I'm saying if you think about that possibility that there's collapse, and you think there's a possibility, a moment of opportunity, that anything could happen right now, could the countries that have not been able to seize power because they've been marginalized and left out of the OECD structure intentionally for years, could they just seize the moment? Could Brazil be like, okay, Brazil is in charge now. Anybody who wants to come to the meeting and cooperate, Brazil's hosting. Could they do that? Nobody knows, right? So I thought this was kind of a radical idea until my prime minister took the stage at Davos. And then he starts telling the story and he talks about the middle powers. And I'm like, oh, okay, this is not radical. And because Mark Carney is not very left. He's very right. He's very Reagan. He's Republican. He's like kind of an anti-tax kind of guy in a way. I know this is being recorded. I should be a little careful, but he is privatizing the airports kind of guy. He is not a let's build up the welfare state kind of guy, right? So, but we're speaking the same language, and this shows you that, you know, you can even have different ideas about what you should do to solve the problem, but you still identify the problem the same way. And he started talking about this, like, well, Canada doesn't actually have much choice here. We're going to have to work with the other middle powers, or the other, I think he called them middle powers. I mean, he likes to push Canada, like Canada's important. No, small. Okay, you know, we've got things people want. Well, do we? I don't. Maybe some maple syrup. It's nice. All of you would like some maple syrup on your pancake. But the point is, when he started talking about that, I recognized it, right? Because he's saying this idea that, well, if we cannot rely on this partner that we have built our entire economy around, we have built our entire daily economy and every assumption we have about how money and finance and trade is supposed to work, we have built it all around a reliable connection to this behemoth country, this monstrously huge country. And we are a small country. And if we have no choice, we have to contemplate collapse. We have to think about, well, what happens if we don't have any of those relationships? For example, if the longstanding NAFTA, which was the North American Free Trade Agreement, which became, depending on where you're from, CUSMA, USMCA, or CUSMA, or something, depends on where you're from, Canada, US-Mexico agreement. That's up for renewal in a month. What if that collapses? What if that collapses too? What happens next? What about airspace controls? We've been seeing some stuff about that. What about? So in the end, the paper is somewhat agnostic about what is going to happen. I think boomerang, in the back of my mind, I think boomerang is going to happen, and I fear it because people will celebrate boomerang. They will say, everything's calm again, we can resume, everything is going to be okay. And when we should be thinking Hail Mary before the US comes back, if we're gonna rewrite the international rule order, we got to do it before the US comes back. And we got to set those terms and conditions so they have to accept them, just like we accept Apple's terms and conditions when they change the rules, and Spotify and whatever, right? We accept all their conditions. We don't have a choice. That is the world that is possible. We just have the possibly tiny window, and it's very scary. It's very scary. And when people think returning to the status quo is the optimistic view, then it's very scary to think, okay, but what if that's not an option? Then we have to start thinking about what we're building to be the new status quo next time. This is like a moment. Okay, so that's the motivation of the paper. In the end, I say, we're at a turning point in global tax cooperation, and there's these possible futures that I'm sketching out in the paper. We don't know which one is going to happen. I think it's probably more likely it will be boomerang, but it's clear that the roles that people take today will define what happens next. And I just see this opportunity. Come on, we can do it like right now, and it's gonna disappear because cooler heads are going to prevail, and they're gonna come back, and I think, or they're gonna collapse the whole thing, which is even worse if you hang on to the status quo too long, while the logic of that status quo, which was already working against you, completely turns against you, and then it's too late. So we have this moment. We've got to carpe diem. Okay, that's it. That's my paper. Thank you very much.
Nice.
So thank you so much. I have to say we are all in a dark place. So let me think about, because this is what I have heard a lot of international tax scholars. So it's interesting to say it is. But let me just go before I go to the room. Then there is a question for Peter Hongler. You have a question for Peter or for the?
Just a general comment on both, I'd say.
Okay, let me just go first to Peter, and then there is a question to Peter, and then after I will go to you, and then I will ask another question that Peter will be asking. So for Peter, what do you think will happen to developing countries? So countries like, for instance, Indonesia, who are so keen in applying Pillar 2 in their legislation. Peter, please go ahead.
Yes, thank you. I think post side by side, every country will do again its analysis. And the analysis consists of two things. First, the legal risks. And every country has a different constitutional framework, and the treaties work differently depending on your jurisdiction. And besides the legal risk, you will have to deal with the competitive question. So are you more competitive sticking to side by side, or are you more competitive if you get rid of the Pillar 2 project in total? And I think that's the analysis every jurisdiction has to do. So if a developing country has depended a lot on US investments enabled through tax holidays, maybe it's better to get rid of Pillar 2 of the QDMTT as an example. However, if your jurisdiction has traditionally had a tax rate of above 15%, of course, then the story is different. So it very much depends on, your macroeconomic position and the legal risks attached to Pillar 2.
Thank you so much, Peter. I will just give the word now to Derek, and I know that you have a question for Alison. I will ask after Derek, and Derek will have a comment. If anyone has any comments, please raise your hand or just put it in the chat. I will just turn 1 second the camera for Derek Burkhauser. associate professor here at Leiden, and we will see. Yes,
Yeah,
please.
so Dirk Hoekhuizen, Leiden University, and the Belastingdienst tax authorities in the Netherlands. So my reflection on this is, okay, we're looking at this crystal ball, right? So we have to now theorize what's going to happen. And I think that's generally a very difficult thing to do unless you're building that up in terms of theory. So what theory do you then use? So this is what Laurens van Apeldoorn and I have been working on quite some time. And I'd say there's two strands of main international relations literature that can guide us in this sort of thinking about this topic. It's institutional liberalism, where you assume there's a positive sum resulting from cooperation, and that's what I'd say is the main idea that's been driving our ideas on international tax cooperation so far. And there's the competing frame of international realism, assuming that cooperation only takes place if there's a big power underscoring cooperation, and cooperation takes place if this big power gains relative gains vis-a-vis everyone else in the world. So my first question is, do you think we're now seeing that the dominant frame has become international realism in international tax? And if that's the case, then that might also, well, that relates to Peter's idea about realpolitik. So it's not about positive sum games, but it's about zero sum games. And it relates to the idea that if you'd say, Alison, that we're now going to that's sort of the Hail Mary mode where we can take back control of international tax. You're also saying that the US as a big power is losing influence.
Yeah.
And at the cost, for instance, of China and BRICS countries.
Yeah.
And therefore, you must also accept the inevitable change of power politics.
Yeah.
Meaning that rules follow. That's a realist idea. International rules and international corporations always follow power structures, not the other way around.
Right.
So I think the two ideas are mixed in your paper.
Yeah, for sure. Yeah, good.
So, and if I now finally reflect on your idea of the boomerang, what you're actually saying is the classic idea that everything must change for everything to remain the same,
Yes.
right? Yeah. It's look at it. You get the part. It's a classic Italian novel. Yeah. So we can only. Let's say that this is perhaps the most likely scenario if you look at the world from both frames. I'd say, even under realist premises, there's a big reason for the US not to be willing to give up control.
Yeah,
and not to be. And let's say the status quo has been very advantageous to the US.
Yeah. Clearly,
yeah.
Right.
So let's say. So my thinking in this respect, and Laurens' thinking is let's split along these more theoretical lines.
Good.
It gives you,
Yeah.
help you to get some more clarification.
Yeah. Excellent. Thank you for that. Thank
Sorry
you.
for a long quote there.
No, that's a nice intervention. A lot. Thank you for that. I think it's I'm not an IR theorist at all, and
Me neither.
yeah,
It's fun to look at.
But it is exactly it is fun, and we may end up we have to be right, just like we have to be economists in a way.
Precisely.
Tax people, we don't have a choice. But so Peter may have things to say, and I want to make sure he gets some time on this. But here's my question for you: if the international rules follow the power, and we don't actually know who has power right now. Right, like based on Trump's visit with China, believes they are the rising, and the US is
the collapsing power.
Collapsing, right, and it was very clear. But based on, if you listen to Trump, which I don't know why you would, but if you did, he absolutely, they're the hottest country. No one's ever seen the likes of this country. It's the hottest country, right, and. But a few years ago they were dead, and now they're the hottest country. All that. So there's a lot of posturing around. But if you look at the money, Peter's graph, the bubbles, I mean, that is
still really
extraordinary. Yes, that is extraordinary. And I think this idea that the rules follow the power, it's clear that it's their, and then the power follows the rules, right? That how do you explain this? Like if I get some power, just like if I get some money, I'm going to get more money. And if I can't get any money to begin with, I'm not going to get any,
Yeah.
right? It's like this. It's something like that. Yeah, exactly. So just hanging on to even the illusion of power continues to provide this economic power.
Yeah.
Then
We use power
if we
still real, I
believe
think,
it,
yeah.
right? It's like, almost like if we believe that it's happening,
Yeah.
that the power is still in the U.S., we continue to invest in the U.S.
Yeah.
And if you don't believe, if you actually believe that the U.S. is going to, obviously, I don't believe they're going to collapse, because then I wouldn't have any U.S. Investments. I wouldn't be making plans to, visit or do things, right? And nobody else would either. So,
But
Yeah.
let's say, I don't think it's the.
a little, because there is another
Yeah.
question in line.
yes.
So
Maybe
I
the idea is not about absolute power, but relative power.
Yes,
Maybe
yes.
that's the idea.
Yes.
let me just go 1
Yeah.
second, because Peter has
Very
to
nice.
move to a mobile telephone. So Peter,
Oh,
do you want to add
yeah.
something? He has 2 minutes to add
Good,
something.
please.
Yes, maybe 2 points. One is, I think in tax matters, we do not have a lot of global problems that require global solutions. And I think we underestimate that. People tend to believe we have a global problem when it comes to the allocation of tax rights. That's simply wrong. We might have a global problem when it comes to cross-border tax evasion, because if some countries, are not committed, then it gets really difficult. There, we might have a global problem. So why am I saying that? I think the realism perspective is very dangerous for weak countries if we try to solve global problems.
Mm-hmm.
So
Yeah.
this is why I'm such a big supporter of a principles-based framework convention. There, the protocols will enable the coalitions of the willing, so, where you have a positive sum at the end, to agree on stuff. So an example that is striking, why have we not yet found an agreement on taxation of kerosene? It's an obvious example. We should tax kerosene, but we have not yet found an agreement. But if we would have a coalition of the willing within the UN Framework Convention, they would all say, let's agree. And then, most countries would jump into that, because the result is of a positive nature for all of the cooperating states. And I think that, might explain some of the aspects that are relevant here. Sorry, it was a bit chaotic. Thank you.
No, thank you so much. I will just turn to myself, because we need to move towards the presentation of Suranjali. We will continue with the discussion. There is another time for Q&A at the end, after the presentation of Suranjali and Tarcisio. So in this, Suranjali, please, the floor is yours. Thank you so much for being here.
Thank you so much, Irma. And I think the previous presentations have already alluded to what a messy world we live in. The attempt that I will make now is to join the dots of what we've been seeing in India and for countries in developing world on what Trump has done and how that has an impact across all kinds of taxes. And I think we've been very focused around the international tax regime, which is just the cross-border taxation of incomes. But what we've seen, especially for countries like India, is that there is a strain on the indirect tax side as well. So I will just going to share my slides. So last year was particularly difficult for countries like India, because the trade relations with the US became strained, and we're all well aware of the fact that Trump tried to slip in the retaliatory taxes within Section 899 of the One Big Beautiful Bill Act. And so that was eventually removed, but then through the negotiation of better terms for trade agreements, these tariffs were imposed. And as a consequence, the economic outlook for countries like India has been not so good, even though the rate of growth is about 6.4, 6.5%, but we're still sort of looking or staring at trade disruptions, which could well go on for the next 1 quarter or so. So I want to start with the question that are direct taxes still in vogue? Because what I see is that there is a subtle shift towards indirect taxes. And why I say this is particularly because of what I've just mentioned, is the rise of tariffs. So this is a graph which looks at tariffs over the last century or more. And what we see is that, after Trump's entry into politics, or sort of assuming his role as the president, you see the jump in tariffs going up to 22%, which of course other papers mention at 27%. But there's a very interesting outcome that we see over the next few quarters or months since these tariffs were put in place, and Geeta Gopinath and her co-author calculate the effective tariff rates that were observed for the US in the months after these were levied. What is very interesting is that the actual tariffs have been around 10 to 14%, and they've not risen as swiftly. What does that say about the trade system? It means that it is, in a sense, broken. It could be that countries are diverting their trade through other jurisdictions, or in effect, these are not being passed forward, or being realized. So what we see in the bottom tabulation is what was the incidence of this tariff. It's quite ironic that Trump wanted to guard the market and sort of sell the idea of the fact that US could be more competitive. All these firms would move their production back to the US, and in a sense, it's protection of the domestic industry. But interestingly, about 86% of the tariffs are being currently paid by the importers in the US, and which is why you see that things still go on as usual in terms of economics, even though we see that countries like India are fearing the fact that there is a slowdown from their export potential. There's been a push to sign FTAs with other markets in order to explore diversification of exports. What is the point of saying this? It is to say that customs tariffs have become important for countries like India, and these will become a source of revenue mobilization for other countries. The other important implication for this is also linked back to our international tax discussion. So we're talking a lot about how these minimum taxes will be applied, whether there's a backstop to companies reducing their effective tax rates. But if we presume for the moment that Trump can take unilateral actions to protect domestic industry, then application of rules of Pillar 2, which may be assumed as not in line with as they prefer it, could result in such actions. While it may be so that they are paid within the US, these tariffs are paid within the US, they do cause disruptions within international trade. So it is a point to think about, because even for the EU, I remember when the negotiations on the FTA were ongoing, a lot of it had to do with also the formulation of the side-by-side agreement. So it's a give and take format where such pressure tactics could again play out if we have Trump in the place of president in the months going ahead. The other important implication of Trump for taxes has been that we've seen the escalation of the war between Israel and Iran. And what this has done is that it has sent a shock throughout the world economy. So we've seen that inflation has firmed in economies, including the US, to levels which have not been observed for many years. And what this does is that it creates a conundrum of what countries need to do in order to absorb the effect of this war. So one direct way of doing this is that the central banks raise the cost of capital or the cost of borrowing, and to fight back inflation, but this is a supply shock. And so what many countries have done, and I've just sort of put a list of countries together here, is that they have reduced the excise duty across jurisdictions. And this has a major implication for domestic resource mobilization. What we're seeing is that tax has become the shock absorber. While this is possible for the next, let's say 2 to 3 months, this is not a long-term measure. In fact, Peter spoke about the interest rates going up. We've observed that the yields on government securities could be going up, which means that this effect of taxes would soon move on to the balance sheet of the government in a very different form in terms of cost of borrowing. Having said that, for the moment, taxes remain a concern where there's a loss of revenue, even though the price of this commodity has gone up because of a cost of living incidence. So I think there are two major effects, both in a sense which work to the indirect tax side, which is the imposition of tariffs, which have an implication for cost of living, and then you have this war, which has been protracted and has an impact again to the cost of living and is being absorbed at the moment in terms of taxes. And I say that this is quite important because if you look at the latest G7 communique, it talks about domestic resource mobilization as an important aspect. So if that is so, what do countries do when they have an absolutely uncertain economic environment that they're operating in? So how do they imagine a tax system which is more stable or forward or long term looking, as opposed to economic situation which is short run and very uncertain? The other important development is that it's again a system that we observed, or we observed these trends during COVID-19. We remember that in the time when there was lockdown, economic activity sort of slumped. We did have the share markets or the equity markets doing much better, looking resilient. And I think that's exactly what we're observing, not just for the equity markets or global financial markets, but we're also observing that for profits of oil companies. So, very interestingly, you have British Petroleum, which has more than doubled its profits during this period. Exxon and Chevron, which are US based entities, and they have quite a bit of presence, I believe, in the Middle East, in facilities that were impacted or were hit by retaliatory actions by Iran. Nevertheless, they have posted net income, which may be down for the moment, but has surpassed the estimates made by analysts of what might be their revenue for the quarter, given the war. And then, of course, you have the companies operating within Middle East, like the Saudi Aramco, which have seen about 25% jump in their Q1 profit. So you look at a world where we talk about countries taking on the costs of this war, costs of the tariffs, through changes in their own tax regimes. But at the same time, you have companies which are large corporations, which would in fact qualify under that sort of threshold of Pillar 2. And while they may have effective tax rates which look on paper aligned with the principle of 15%, but they are in a position where they earn supernormal profits. And I believe that there are experts who raise the question of, could you have a windfall tax? In India, we've tried to implement a windfall tax on oil producing companies in the past, and I believe that that is a possibility. But there are distributional consequences which are not just for countries like the US or the UK, where these companies are housed. It's also for developing countries which are stranded at the moment in terms of supply. And so that leaves the question of, even if you do tax these profits as a way of equalizing, the distribution does not sort of flow back to countries like India that may be severely affected by the adverse impact of the war and the supply of oil. But again, just sort of highlighting that there is sort of an unequal system that has emerged after Trump globally. So going back to the question of Pillar 1, which we've completely forgotten about because, in a sense, the project is no longer alive, whether it's in administrative memory or in terms of active negotiation. But I mean, this is a question which I think is a little rhetorical. We know that we do need a tech tax, but I think it's become even more important after looking at how AI is shaping the market. Of course, every technology has its own cycle of boom and bust. It is quite possible that some of these companies, their revenues and the profits may be inflated for the moment because of the hype around it. But nevertheless, there is a trend of that we've observed within AI, that there is massive expansion in investments and there's extreme concentration. So you see large companies emerging in the space, just like we were talking about, taxing digital companies in 2018. I think some of these have again sort of emerged as a big question mark in the AI space. And I think it makes it more complicated because we've not really answered the question of value creation, even though, in a sense, Pillar One was supposed to, in its formulaic approach. I think this need is going to become even more pronounced. And I think Alison and Peter have already spoken about the prominence of US. But I just want to sort of show this map of the world of where AI companies are located. And this is a Bank of International Settlements paper recently published, which maps where these AI centers are located. And just through this heat map, you can tell that for us, in terms of international tax, we're going to have another set of issues emerging just in interaction with the US. And of course, not to the same extent, but then China. So in this sample, about 1,246 firms that they had looked at, they see that, while they're across 32 economies, 700 are in the US, and 250 in China. And of course, Peter mentions that there is the issue of competitiveness, lack of competitiveness in the EU, and you see that with the relatively small number of firms. But what does this mean in terms of tax policy again? Not just in terms of international tax. What we're seeing now is that there's a revival of industrial policy, and I say that because I observe that even for India. So there have been quite a few interesting developments in this space, which are worth mentioning. So, yeah, so I think there are three important developments in the Indian tax context of what's happening in terms of attracting tech companies. So one is we interestingly were the front runners in terms of having introduced the equalization levy, which was a digital service tax. And part of the trade negotiations, you can call this as a fallout of the trade negotiations, or you can say as a way of bringing in more tech companies. The equalization levy was removed, last year. Then you have two other interesting developments. So while India has a corporate tax regime now, which is sort of cleaned out, there are not as many incentives. Companies can opt for a simpler regime where you have a lower tax rate and you don't avail of tax incentives. And while that rate is about 25%, companies are now being offered a new sort of incentive where data centers set up within India would receive a tax holiday for 20 years, which is a long period of time. Of course, there are caveats to that. There has to be a selection of the foreign company, and its Indian operations have to be facilitated through a reseller, which is located in India. So, in a sense, there is a partitioning of activities that take place in India versus this company servicing all other jurisdictions. But I think the construct of incentives has sort of changed, but it's evolving, and it's also sort of bringing back the question of whether incentives are still relevant or will they continue. And I believe that they will, and they will just be reframed in the context of AI, or you will be seeing that in the context of green transition. The second important development is again on the safe harbor. So one of the most contentious issues for India has been the profit margins which are reported in the IT sector. Now, this amendment offers a safe harbor of 15.5% margins for all kinds of IT services. So they're sort of clubbed IT-enabled services, KPOs, R&D centers, and that, in a sense, while it creates certainty, it is a bit of a giveaway to some segments which would have much higher margins. So I think the safe harbor is again a way to say that we want more tech industry within India, and I think we're seeing a revival of these incentives. Now the question is, how does this sit within the Pillar 2 regime is a big question mark. And then, just to comment briefly that I've said this before, that India has a minimum tax. There are ways to ensure that that minimum tax, which is above the 15%, is sort of paid for within India. And in terms of companies that are Indian MNEs, there is limited companies that would qualify under Pillar 2, and so therefore it's not a big issue in a sense. Therefore, the Amendment to Income Tax Act do not really incorporate anything aligned with Pillar 2 at the moment, while it's still sort of wait and watch. What I did find interesting is that the Indian accounting standards are now adapting, and that's because we follow international standards, wherein companies will now begin to assess, the proportion of their profits that may be affected by Pillar 2, the changes in effective tax rates. And so even while our Income Tax Act may not swiftly align to these global standards, it is possible to get a sense of what the impact may be of Pillar 2 on companies in India. So there's a limited and marginal impact. But I think if you sort of zoom out and look at the big picture, there are many more themes evolving which affect India in a different way. One is just the impact on indirect taxes, the reframing of incentives, which I think will hold more relevance and have become extremely important for India after Trump's presidency, than just talking about Pillar 2 or even Pillar 1 under the OECD. So I'll stop there and thank you so much.
Thank you so much, Suranjali. You didn't hear, but everyone here clap also for you. So we are still in a dark place, but let's see what we can do now with Tarcisio with his presentation. I know that Aicha has a question, so I will do it after the Q&A. And if anyone has a question, raise your hand or put your question in the chat. But I will give now the word to Tarcisio. Yes, I think that we are okay, right?
Yes.
Okay, good.
Okay.
Tarcisio.
Perfect. So, well, first of all, thank you so much, Irma. It's wonderful to be back in Leiden. It's wonderful to have the opportunity to discuss this paper in particular. So this is something I've been working on for some time now, but I hadn't had a chance to present this to a EU audience. I presented this last year in Canada to this workshop with Ivan, but here I have a better chance to see whether these arguments make sense. So what am I trying to do here? So I'm looking at this specific case and trying to connect it to this debate on the position of the US in terms of other countries and what it's doing to the international tax system. You see from my title, the US has been the first one to sue the global minimum tax, right? Other countries have not done so, but American companies have been pushing this idea that the global minimum tax violates fundamental freedoms and fundamental rights here in Europe, which is something I think is mistaken. You might have seen, I wrote with a couple of scholars a amicus curiae. Well, it's an informal amicus curiae. The court doesn't really receive amicus curiaes, but we did so in order to position ourselves with a different perspective. So before I get into the nitty-gritty of the case, I just wanted to position this debate in terms of a longer history of law and political economy. And this history goes a long way back. What you can see on my slide is the long list of papers and literature that has been produced recently, and that has been very critical of how corporations, especially large corporations, have throughout the years claimed more and more rights in courts. Right. So if we look historically, this goes all the way back to in the US with the Lochner era, which was an era known for the courts striking down regulations for employees. The Lochner case was a case about bakers, I think, and then there was a limitation on how much they could work. So Supreme Court at the time said no. This violates freedom of contract or freedom of business. Then that lasted until the New Deal. Then it kind of got back in the 1970s. And then you started seeing, again, the case of the Supreme Court extending rights to corporations that were not necessarily known to be extendable. So you see, freedom of speech being extended to corporations and religious freedom. Hobby Lobby was a case where contraceptives were being denied to female employees because he violated the religion beliefs of the owners of the company, and the Supreme Court said it was okay. So we kind of see, and the literature points the same kind of happening in Europe. In the beginning, there was this understanding from the jurisprudence, which was that rights are absolute, corporate rights are not absolute. They have to serve a social function. They have to be subject to broad interventions by the government. And throughout the years, they have claimed and brought up cases, and the court has kind of extended their rights, applied different theories, and then you see a kind of move away from regulations that could have limited corporate power. So what about the global minimum tax? The global minimum tax is a more recent story, right? Starting in 2021, we have the agreement. Back then, Biden supported it, so he had the support of the United States. The Secretary of Treasury at the time, Janet Yellen, said it was going to be the end of the race to the bottom. We know that that's not true. So 2022, the EU adopts the global minimum tax directive. Belgium then implements it and puts it into law in 2023. 2024, M3, which is this association, it's basically this chamber of commerce in the United States, files a NOMA petition at the Constitutional Court. Other US-based business associations join. Then, Trump comes into power in 2025. First thing he does, let's get out of the global minimum tax. And then he threatens to impose revenge tax on countries that continue with the global minimum tax. 2025, we have the side-by-side agreement excluding the United States. And then the Belgian court submits the case to the Court of Justice, where it's sitting there. And then, we have other countries now trying to get out of the global minimum tax, which doesn't seem so strange if the United States got that exception. So what happened to the case? So this is one of the main arguments that we put in our amicus, which relates to the admissibility of these associations at the Court of Justice. What you see on my slide is basically, this is the decision of the court. It's this short in terms of admissibility. The court said, so these associations, these business associations, they represent American companies. Because they represent American companies, they're directly, and these are the words of the court, directly affected by the global minimum tax, specifically the UTPR in Belgium. They say, well, they defend collective interests of these companies. Again, they're directly affected. Not much of an explanation there why they're directly affected, except for the fact that these Belgian companies, they're going to be taxed by the global minimum tax in Belgium, belong to a multinational group that happens to be American. But then if you look at the directive, we see that the terms of the directive contradict this understanding there's a direct link between a tax imposed on a subsidiary or permanent establishment in Belgium and the multinational that owns it, right? The definition says an entity is any legal arrangement or any legal person. A constituent entity is any entity, any permanent establishment that belongs to a multinational group. But then Article 2 on the scope says the directive applies to constituent entities located in the member state. Right? So here we're talking about a national tax, which was always the idea of the global minimum tax, the mastic measure. So national tax applied to a resident. The directive does innovate in a way that it treats permanent establishments as entities. Right? So here we see a little bit of a change in how it is treated, but those are the taxpayers. Right? The taxpayer is a Belgian company paying Belgian tax, not an American company. It happens to be owned by an American company, but who knows who else owns what going up the chain, right? You're going to also find a shareholder all the way up that could be, in China, in Brazil, and anywhere, or also even in Europe. So here's the legal question, I guess. So the question is, who can actually bring a case and challenge a tax before a court? Right? So this is not a new question. It's a very, very old question. And usually, so it relates to this idea of there's a legal taxpayer and an economic taxpayer. But the answer to this question has always been that the one that gets to go to court is the legal taxpayer, not the economic one, right? Incidence is something difficult. We don't know who actually pays any tax, not just the corporate tax, any tax for sure, right? We see this with the VAT. The VAT is charged on suppliers, passed down to consumers. Who can go to court to complain about a VAT? The supplier, not the consumer. I cannot go to court and complain about the VAT that is being imposed on the products that I buy, right? And we see this with tariffs as well. So the tariffs that Trump imposed recently that were declared unconstitutional. Who gets to get a refund? Who gets to obtain a refund from a tariff that was imposed on the importer? And the understanding has always been that it is the importer themselves, not really the people who pay the tax at the end, right? And with the corporate tax, what happens? Well, there you have all sorts of possible bearers. You have the shareholders, the workers, the consumers, the suppliers, landowners. Who else around the world that could be bearing this top-up tax that is imposed on Belgian companies, right? If it's passed on through prices or passed on somehow through a corporate structure, it could be anyone. So how can we say, how can we determine who gets to go to court and complain? The only understanding that we always had was that it has to be the taxpayer identified in the law. Otherwise, it could be open to any person basically in the world. So you see a quote there from 1935. The federal courts have seldom concerned themselves with the question who bears the burden of the tax. Rather, their inquiry has been limited to asking who is the taxpayer. So courts have most of the time, refrained from getting to economics, getting to ideas, because we don't actually know who's paying the tax in the end. So this creates a paradox, right? So here we have a group of U.S. business companies, representative business interests in the United States coming to Belgium, entering a Belgian court, asking for a Belgian law applied to Belgian companies to be invalidated because they feel that they are being affected. Well, we could all be affected by this tax if we consider it the economic incidence. And then to make things worse, their argument has this internal contradiction where they argue that they, in terms of admissibility, we should look at the multinational group as a whole, right? U.S. multinational group. But when it comes down to analyze the merits of the case, so what violates fundamental freedom, what is discriminatory, what is restrictive, their argument is that the small subsidiary in Belgium paying the top-up tax, that one is being discriminated against another small subsidiary standalone that is not paying a top-up tax. So it's not the multinational group. So what is the answer here? Who do we look at? Do we look at the whole group for admissibility, but then on the merits we go back to separability? Or do we look at the whole group again? And then if we look at the whole group again, the group is very profitable, have high ability to pay, could pay the tax without any infringements. So here you see their arguments. They raise all sorts of arguments. Some of them don't really make sense, such as the right to work that is only applied to people, not really to corporations. But then there's the right to conduct a business, property rights, establishment. But at the end of the day, the entire argument sits on the idea that it is discriminatory or affects the property of a company because that single PE or that single subsidiary might not have enough money to pay a top-up tax that is imposed on the group, right? Now, if we look at the directive, and here are the options that I think the court could have. I think the Belgian court should not have accepted this case. I think this case relates to Belgian law. This is a clear interference of American companies into domestic legislation, to the union. Why do they go to Belgium? It was strategic as well. The Belgian court is known for referring things more easily to the Court of Justice of the European Union. And once you get there and you get the precedent that you want, again, claiming more rights, it applies to all EU states. Then you get the piece of the cake that you were looking for. What can the CJU do right now, right? I don't know if this is possible, so maybe a EU law expert can tell me this. I think that the court should just toss the case, throw it out completely. It doesn't make sense. They should not have gone there. But if they get into the merits, I think if the CJU does not declare this case moot or complete nonsense, what's going to happen is that multinationals are going to continue to claim more and more rights, even after Trump leaves office. So what can be done? Well, you have they're kind of a list of things the court has done in the past. Sometimes the court understands a directive to exhaustively harmonize a field, and then the court says, well, I'm not going to pass the directive. I know this is controversial. Some authors will say the directive can still be tested against primary law, primary EU law. But the court also sometimes, what it does is that it recognizes that there's a restriction, there's a discrimination, but it should still be accepted for public reasons. And we have a public reason here, which is, this idea that we have to contain harmful tax competition, or raise the bottom tax competition. The court can even create new ones. Rule of reason. Sometimes the court says, I'm not going to get involved into this complex issue because this is for the legislator. The EU legislator should decide. And if I intervene, then I'll be just replacing myself for the legislator. That shouldn't happen. So this is called broad discretion, wide range, wide margin of appreciation, where the court only looks at manifest error, which doesn't really exist here. Now, the first to last is the one that I think the court should embrace, which is to look at the group, right? The directive defines a multinational group. The directive is meant for multinational groups. Why are we still talking about individual companies? Now, if the objective is to ensure that large multinational groups pay a minimum level of tax, then this is what we should be considering when we're assessing whether there's any violation. And then obviously, courts are not, higher courts are not bound by precedents, by their own precedents. They can change their mind, they can evolve, they can adopt new interpretations. So the court has a lot of room there to work with this. Whether this is going to happen or not, it's something to be seen in the coming months. But I think if it does, we're going to see more and more corporations from the United States being more dominant. I think what we saw in Peter's slide about the size of US multinationals, that's going to continue growing even more, and it's going to end up eating the entire cake. Thank you so much.
Very good.
Thank you so much, Tarcisio. Let me just stop sharing. The slides will be also available. The ones who have slides will be also available after with the recording. I want to give first the word to Aisha because I know she had a question about the previous panel. If you have a question now regarding the presentation of Suranjali, the presentation of Tarcisio, please raise your hand. I see one here in the room, and then after also do it via chat and let me know. So Aisha, the floor is yours. Please ask your question.
Hi, Professor. Thank you. Joining from NYU Law, I'm Aisha. I work for the International Tax Program at NYU Law. I work for Professor Miranda Stewart. My question is for Professor Christians. On your presentation, I have a comment and probably a question. Can we imagine a scenario with a boomerang but a sprinkle of Hail Mary? I am basing my comment on 3 proxies that I have noted here. One is coordination from the Global South that I've seen at the UN during the UN Framework Convention negotiation. The Africa group is very coordinated, and this is based on lessons from the past. I think they have done a fair deal of negotiation at the inclusive framework. And secondly, it is question of timing, because right now with the digitalization of the economy and the pressure on cross-border services, it's an interesting timing. And third, I have here it's a lesson from the past, because I believe international tax is a wicked problem. International tax cooperation is a wicked problem that we can only try to resolve over and over again, because it sits at a regime complex where we have different kind of international organization with sometimes opposite or competing mandates. And I think they have done a great deal of negotiations and they have learned from the past. So my question is, can we see and expect a scenario where we have a boomerang, because the US will not want to lose the momentum, and if you cannot beat the process, you join it?
Mm-hmm.
Thank you so much, Aisha. I will just give the word to Alison, and then I will give the word to Derek here in the room, but please, Alison.
Yeah, I mean, it's great. Thank you. That's a terrific question, and it's a brilliant assessment of what's likely to happen. So I think you have the best crystal ball. This is very likely. I'm worried about this outcome, that I think you correctly, because I think it's you can help me with this a little bit, but I think it's like if you allow the structure, the old structure, we will default to the path dependence, even though we're, and I think, Tarcisio, you have better words for this than I do. So I think you can see that even the US companies using the structure, they're using a structure that we know in order to get back whatever power is lost somehow.
Yeah.
So that would be my answer, but you may have, maybe you can add to that idea.
No, I fully agree. I think the path dependence issue is real. It's difficult to change because we're used to this, going back to structure. Law in itself has this more traditional, right? We're always looking at the past and seeing what is it that exists that we can use for the future. What I would say is that I think this history, and this might be a question, not just a comment. So this rupture that we're kind of seeing now, is it really a rupture, or is it just the result of a long process that comes all the way from, right? Like if I look at what the United States does, the United States have always intervened in ways that doesn't apply to them. I mean, I come from a country where the United States supported dictatorship for 20 years, right? Like also supported the coup in the past. So I'm not sure whether we can rupture with this path dependence. And even if what we're seeing is rupture or more an obvious shedding of light of who was always in power.
Thank you so much. Let me, I guess, give the word to Derek. Aisha, thank you for being patient and for your question. I will give the word to Derek, and there is another question in the chat, but please raise your hand as we still have 60 minutes, so there is enough time still for discussion. Please go ahead.
Okay, so Tarcisio, the thing that came up in my mind was the climate cases in the ECJ report. They involve a similar kind of idea, right? We don't know who it impacts, and I think the court structurally denies access admissibility of these sort of claims.
I'm not.
So maybe there might something.
So climate change.
The case. I just asked ChatGPT. Carvalho, the case Carvalho.
They were not the same, but I didn't know. I'm not very sure, so I thought that it's historical. So there are a lot of historical cases.
Can you speak up a little for the mic?
So there are speak like me. So you have a lot of tort law cases in corporate social responsibility, and often one of the subsidiaries is in a certain country, and there is climate impact or also a human rights violation.
Right.
And then also the question there can appear: who has to pay? Is it the daughter or the mother company? And it depends, but I'm not very familiar in this field, but it depends on how much impact the mother could have had on the operations of the mother. But I think in tax law, for tax offset, so in those cases, it's often also did the subsidiary locally do whatever you should do. But for tax avoidance, you can only avoid tax because you have the whole.
Yes.
Exactly.
Yeah.
So there are a lot, and it's not only for climate rights, but also for human rights. Areas about it. And I give some recommendations for literature.
Yes. Thank you so much.
Thank you so much. I think that this is very nice. I will give now the word to Fahad Nuhu. Can you please introduce yourself?
Thank you very much for the wonderful presentation. I hope you can hear me.
Yes, we can.
I wanted to find out the impact of the Pillar 2 on developing countries like Africa, precisely Ghana, where I'm currently now. So I want to help me on the effect of the Pillar 2 on the developing countries. Thank you.
Yes, thank you so much, Fahad. Who would like to answer? Suranjali, perhaps you will give it, because by the way, we also have on the 10th of June the policy options regarding after the side-by-side agreement. So Suranjali will also be presenting there. But Suranjali, we're putting you a little on the spot. It's not about VAT, it's not about trade, but you will be also one of the speakers at that moment. Can you please share your views?
Yeah, I just want to comment that, of course, it depends on the kind of incentives that countries offer. And at the moment, there are ways to sort of assess, existing minimum taxes as well as incentives and exemptions, which I think countries such as Ghana should begin with. The impact, although, would be felt only if there's the presence of companies that qualify under the threshold applicable to pillar, threshold applied to certain companies for which they qualify under Pillar 2. So I think Ghana would have to also look at how many companies are operating within their jurisdiction, or how many of their companies qualify for this, and so they should look at other jurisdictions where this company is present in terms of calculating effective tax rates. My sense is, from the work that I carried out a few years ago, is that it's quite limited. And I think it's also the next steps are in terms of capacity building, of understanding how the laws are supposed to be designed and how compliance is ensured. Because as I mentioned, for India, the companies do use an international reporting standard, and it's soon to begin, even though we don't have anything in the Income Tax Act. So it is perhaps possible that some of the MNEs in Ghana might start reporting, if at all they follow these international standards, which gives a view of what the effect might be of Pillar 2.
Thank you so much,
Can I just add something before you move
Yes,
on? This seems to me like the moment when, again, I'm a seizing the moment kind of a girl right now, but it seems to me the moment for, I'm not sure if Ghana has a lot of these agreements, but other countries have these long standing investment protection agreements that have unbreakable terms. Now's the time to cancel them all. Like now, do it now, because they're not serving. And if everything is kind of in flux, it's probably going to get sued. But there's no one to sue to soon or possible. So I would just add that's an impact of Pillar 2 that's happening, where this pressure is to tax, and those agreements are to relieve tax with some of the unending terms.
Really all that's left.
Exactly. So get rid of them.
Yes.
I just want to second Alison on that one, because India suspended all its bilateral investment treaties in 2016 because it didn't want the arbitration of tax. And I think that's a good template, because a lot of countries in Africa are also worried about the terms of expropriation and
Latin America.
We should follow them. We should absolutely follow India's lead.
I mean, if we're gonna get rid of everything, global minimum tax, international tax, and then the only thing that is left is investment protection. Then there's nothing.
I know, not benefits the US again. I know.
So,
good.
Yes,
may I add something?
Derek, go ahead.
So for me, the question is, what is actually the purpose of the high income taxing Western world states to go for Pillar 2? What was the initial idea? I'd say it's to prevent tax competition, whilst the high taxing states want to keep taxing their markets in a high way. Having the rest of the world accept Pillar 2 is, let's say, I'm returning back to my realist framework here again, is a relative positive gain for Western countries, because they prevent the rest of the world from competing.
Quite right.
So if you look at from the realist frame, obviously Pillar 2 is only beneficial for the Western high taxing world.
That's it. It's all
So there's your answer for the rest of the world. Perhaps.
Thank you so much. We still have 9 minutes. So we have not solved the problems. We're just asking more questions. But actually, this was the idea of this roundtable. We have also, the Hail Mary also say Samsung. I don't know which person is, but it's a Samsung. I cannot see how Hail Mary can work if essentially ignores a country with 60% of world market capitalization and the bulk of that being digital. So question for Alison is how, in practical terms, it works.
How it works is the rest of the world taxes that 68% market share in any way they want, and they limit access to their markets to prevent those companies from operating unless they that's it. That's the only, the Hail Mary is like everybody just says, hey, we're all doing digital taxes, we're all doing digital PE, we're all doing globe taxes, and we're imposing it on US companies. If you're working in our jurisdiction, you're paying the tax. Does it work? Well, it's collective action problem. Classic.
Again.
Classic.
Can I
Like, excellent question.
Thank you. This I'm not. It's been long since I've been in Brazil, so I don't know how the regime is there. But what What I think Brazil does, for example, is that it limits access to the market unless you're physically established.
Yeah.
I think those companies.
Yes.
So
That's right.
It is done.
Yeah, exactly. It's possible to do. We have some examples, but there's a fear of losing investment.
Yeah.
But honestly, I think this is why I say this is the moment, because you have to say, is it worth it to give up our tax system, to give all these tax incentives, to do all this stuff, to get US capital? It's no longer worth it if you believe that collapse is imminent. It is no longer worth it. So start now.
Maybe just as pessimist here, I work for government and we're very scared that we're so dependent on US tech companies. I mean, I work with Microsoft Office, I work with Outlook.
I know.
What if they pull the plug, you know?
Right.
So even as a, let's say, quite a wealthy state such as the Netherlands, we're so vulnerable in that respect.
Exactly. But we've done that to ourselves.
Yeah.
Look at those companies. There's no local competitor for a reason.
Yeah.
Because they have not paid tax. They have become monopolies. We have become dependent on them. Now there's no alternative. Yeah. That's the world we built. Are we satisfied with that world? No. Now's the moment.
Now is the moment. So I just say, let's have some advice for the UN negotiations. Start that will continue now in August. It's supposed to next year, 2027, they will have, but we are not seeing so much progress. And one of the reasons is because actually it's Africa, Europe, and the rest of the world. And you are saying, let's put all together but let's put all together. But, okay, that's my opinion.
It's not working, or that is working?
It's not working.
They're fighting.
Yeah, actually, if we do not have, there is an agreement between the EU and Africa and other countries who will start involved in Latin America, Asia, and so forth, we still have two groups. The EU, who is following all the discussions from the OECD, and also some OECD countries, and Africa. But we do not have all together. And that's the problem. But that is my view. But I have a question that Peter was asking before, but Lucas has another question. So let me go to Lucas first, and then we go to other question. Lucas, please go ahead.
Thank you. It's precisely exactly about that, Professor. And good morning, Alison, everyone. Congratulations for the event. Yeah, I think we have this difference in the UN because Pillar 2 also benefits Europe, but Europe doesn't want to lose all the other privileges that the current international tax system grants it. So I believe Pillar 2 main objective is to bring back capital to Europe and G7 as a whole, which includes the US, of course. And that's why the UN faces so many difficulties, because the leading voices there for a change are the African Union, and Europe is not ready to give up on all of the other privileges that the double tax treaties grant to the resident states. So I don't know, right? I think that's the real issue.
Yeah, that is such a good observation. And I'll just jump in here to say, like, the contract is still working for Europe, right? We still believe there's mutual advantage in holding on to the past. And then until the moment when you no longer believe that you have a mutual advantage, that you get advantage, until that moment you will go along with that pact, believing that you are advantaged. And until it's obvious to everyone that you have no advantage, you will not break your hold on it. And so that's why this is such a crucial moment, right? Like when all of these things are happening that Europe is very uncomfortable with, right? Like military bases being used for the first time. That's very scary. We're very nervous about this relationship that we have. And the question about whether are we mutually advantaged by all of these other things, that is under debate now, where you wouldn't even ask. Is Europe better off in a relationship, a cooperative economic relationship or not? You wouldn't have even asked. It's clearly they are. Clearly Canada is. Absolutely. We're better off. We're rich because of economic globalization. But if you get the tide is turning, like we are not better off, that is the moment when you will see that you have no choice. Now you have to decouple. But it's messy.
Mhm.
We may suffer.
Yeah.
Yeah.
So with this, I will go back to because we are actually at the end of this discussion. It's 3 minutes to 3 p.m. So we are perfect on time. I like when we are on time. Thank you so much, everyone. For some of you, it was very early in the morning. I know some of you very late. Thank you so much to Suranjali, also to Peter Hongler, Tarcisio, Alison, to all the people attending, and join us on the 10th of June for the next discussion on policy choices after side-by-side agreement. And we look forward to continue the discussion. So thank you, everyone, and have a nice afternoon, rest of the day.
Thank you.